Hello and welcome to Quilter Cheviot Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based out of our Manchester office, and this week I'm pleased to be joined by regular commentator and head of fixed interest research, Richard Carter, and one of our fund research analysts, Simon Woodacre, who is responsible for our Japanese equity coverage. A very good morning to you both. So quite a lot to unpack from last week, and a typical roller coaster week whenever Trump is involved. Davos, probably the main focal point with some interesting speeches, which we'll come on to. Trump continued his threat of taking Greenland or even Iceland throughout his speech, threatening tariffs over the last weekend on 8 European countries at 10%, including the UK. And then his speech at Davos then went on to rule out taking Greenland by military force. And then later on that day, he confirmed he'd had a successful meeting with the NATO Secretary General, and a framework was agreed with a future deal with respect to Greenland. So a sense of deja vu, the typical threat tariffs as a negotiating tactic, bring people to the table and then agree it and pass it off as some kind of deal. So the return of the taco trade, if you will. Current Chancellor also had chance to squeeze in a game of midnight chess against Rishi Sunak, and reports of Reeves emerging victorious on that one. We also saw some big moves in Japanese government bonds, so 30-year yield breaching 4%, and that reverberated across global markets and seemed to be kind of reminiscent of Liz Truss's mini budget back in 2022. There does appear to have been some intervention from the BOJ, and I'd like to get Richard's thoughts on that, and maybe Simon's as well. Just on the impact that would have. Unsurprisingly, as a result of that, gold continued its blistering rally, helped by all of that uncertainty, but maybe a bit of dollar weakness as well. The UK, Richard will come on to the latest labour market data and the CPI print. And then finally, we did also hear, begin hearing the case against Fed Governor Lisa Cook at the Supreme Court. Whilst we're unlikely to get that verdict anytime soon, I think some of the arguments from the justices seem quite positive. Even the conservative-leaning Trump appointees suggested removing Cook would weaken, if not shatter, the independence of the Federal Reserve. So implies that Lisa Cook might be okay, and we're still yet to hear, obviously, that verdict on the Supreme Court use of Trump's tariffs. So, Richard, be keen to get your thoughts, first of all, on the various speeches at Davos and the general tone or message you took from the forum. Mark Carney's speech got quite a lot of coverage, and I've seen a lot of comments calling it the best speech of the conference. He said the world was in a rupture rather than a transition, and that middle powers must cooperate and build coalitions. What are your thoughts on maybe his comments in particular, but more broadly, the conference as a whole?
Yes, Mark Carney, the darling of Davos once again. I mean, I think his speech was interesting, but given what's been going on with Trump and the US and their sort of bullying of weaker countries with, like you say, the tariff threat and then the whole Greenland nonsense. I mean, it's not really a new idea that regions like certainly European Union and Canada and others who are committed to a sort of international rule of law, if you will, should sort of bandy together and stick together against the let's say bullying of the larger powers. Unfortunately, we used to be in a situation where we could sort of rely on the US for our security and to work together well with places like Canada and Europe. But unfortunately, with Trump in the White House, we don't have that benefit anymore. So yeah, it made sense what Carney said. Unfortunately, he's upset Trump once again and had his invitation to the Board of Peace withdrawn. So that's a real downside for him, I'm sure. At least his behaviour, I think, was better than most of the Americans who seem to have just gone over there to try and upset everyone as much as possible and succeeded. But hopefully, at least the Greenland thing seems to have been sorted out for now.
Yeah, it seems like they had a vendetta against everyone that was at the conference. UK CPI, so a little ahead of expectations for December. So I think 3.4 versus 3.3 expected. So nothing major. Does seem to have been, again, some seasonal distortions in that data. And we're yet to see that some of the measures that the Chancellor announced back in November feed through into the rates from April onwards. A lot of the rise seems to be down to airfares and cigarette prices and the timings used for measurement. So I read something from Mike Bell, who's the ex-JPM macro strategist, who kind of brought that to the attention. So linking that in with the labour data that we had out, what is the trend going forward for both maybe inflation, labour market, and where do you think that leaves the Bank of England now for their next kind of decision and maybe rate cuts over the next kind of 6 to 12 months?
Yeah, I mean, yeah, you're right. I mean, those inflation numbers weren't too bad. It was always expected there might be a bit of a blip up in airfares and the rest of it. And so, you've got to look at the overall trend, and that is gradually heading lower. And like you say, some of the measures in the budget might help on that. So inflation should drop, down into the sort of twos as we get through 2026, which is good news. Of course, there's always a danger of some commodities, currency, natural gas kind of shock. But for now, it seems to be heading in the right direction. The labour market is a bit weak by the looks of it. I mean, vacancies, particularly for sort of graduate jobs and all the rest of it, are not great. So we're not expecting a massive rise in unemployment, but certainly would favour the Bank of England cutting rates again at some stage. I think obviously, the MPC, as we know, is pretty divided at the moment, and I don't think the recent data has been weak enough to suggest we could see a rate cut this quarter. It's possible, but at the moment, markets expect the next rate cut to come sort of towards June time, so a little bit to wait for now.
Yeah, a bit too long for my mortgage renewal, unfortunately. Finally, Richard, your thoughts on the moves we've seen in Japanese government bonds and maybe the broader macroeconomic and political backdrop. I'm sure, as I said, the Liz Truss budget rings true in everyone's minds, and there's some parallels there with the unfunded tax cuts, ignoring the advice from the central bank, etc. So I'm keen to get Simon's view from the equity market perspective, but what's your take that maybe linking in the yen carry trade? And we've seen to have that divergence between what fiscal policy intentions are from the new prime minister and then the monetary policy is kind of pulling in the opposite direction.
Yeah, the Japan situation, it's been talked about for a long time in bond markets because they've got so much debt and yields have been so low. Rates have been so low, but it's always been one of those things that have been a worry, and it seems to be getting more of a concern. I mean, the yen sort of carry trade of Japanese investors kind of borrowing, or people who just investors generally borrowing at low rates in Japan and investing in high yielding assets globally. If that were to reverse on higher rates in Japan and stronger yen, that could be a problem. Although if the sort of carry trade is unhedged, so maybe short Japan, long dollar, I mean, it's possible that people could just hedge that without actually selling the underlying asset. So it might not impact stock markets or bond markets so much. But Japan does have a lot of debt. They're going, like I say, they're going from a situation of sort of low rates to sort of higher inflation, higher rates. And the last thing you need when you do that is, as you say, some sort of mini budget kind of, let's just do some unfunded tax cuts and never mind what bond markets say about it. It was a big move in long end JGBs. It does seem to have settled down a bit, but they really have to be careful on what they do. The Bank of Japan can intervene if necessary, and a lot of the JGB market is domestically owned. But they really do have to be careful, and we don't want to repeat of what happened in the UK, because it would not just affect the Japanese, but it would affect bond markets globally. And if we see yields spike up on the back of what's happening in Japan, that can affect asset prices all over the place. So yeah, it's a big deal. Hopefully, they'll tread with caution.
Yeah, definitely something that we'll keep an eye on. So thanks, Richard, for that. Simon, turning to you now. Thanks for joining us. I think it would be helpful maybe for our listeners summarizing what happened in Japan last year, just to give some context. Maybe if you could touch on Bank of Japan's change in monetary policy, the inflation backdrop, and then the election. And we just reference those kind of fiscal plans that she has. And of course, the currency, because that is a big factor for equity market returns in the region.
Sure. Yeah, I think one of the, as you mentioned, one of the key themes of last year was the interest rate normalization that we saw, with the Bank of Japan raising rates in December to the highest level since 1995. A lot of that was driven around concerns around inflation, but also to deal with the weakening yen, which has been weakening persistently over the last couple of years, despite appreciating a bit at the start of last year, mainly relative to the dollar. But that was the theme that we saw. Inflation has been quite high over 2025, but we did see a bit of cooling towards the end of the year. A lot of that was driven by food prices, with rice in particular being rising quite strongly. Interestingly, though, wage growth, despite being strong in nominal terms, was still down in real terms, mainly off the back of the strong overall rise in inflation counteracting that. So then I guess on the main, as you said, the main event in the political front was the election of the new Prime Minister, Sanai Takaichi. The former Prime Minister was forced to resign following a number of election losses, having only been in the position for about a year. The market did respond quite positively to her election, mainly due to her sort of pro-growth agenda, focusing on fiscal spending, fiscal responsibility, tax cuts, and monetary policy sort of normalization. However, as we mentioned earlier, the response from the bond markets, she's promising a lot of fiscal stimulus, but also promising tax cuts, which has caused a lot of stress in markets as a result of that. So yeah, I think it has been a very sort of interesting year, and I think if we move forward, we probably see a similar trend going forward.
Great, Simon. That's perfect. Really helps to set the scene. And as a result of all of that, how did the Japanese equity markets perform in 2025? What were the kind of key trends, maybe sector leadership styles, and maybe comment on the dispersion of returns within the market, as I know it's something you've looked at?
Yeah, Japanese equities performed very strongly over the last year, particularly in local currency terms, outperforming a number of our markets. And value stocks outperformed growth stocks over the periods by quite a notable margin. A fair amount of that was due to the weak yen and the interest rate and normalization environment. Banks in particular benefited from that due to the steepening of the yield curve and the weak yen from their overseas businesses. But also you saw a number of key value names falling quite strongly, a number of that sort of commodity names that benefited from the rise in precious metals due to the high increased demand from AI. But also we saw a lot of large industrial names, particularly those that had large defense components, perform very strongly after we saw a large increase in defense spending by the Japanese government. However, that being said, even though value was the clear leading theme of the year, some of the best performing stocks were actually in the growth space, and there are those that were highly tied to the AI theme. So you had a number of companies that would produce semiconductor testing equipment, flash memory drives, optical fibers for data centers, all of which experienced significant rise in demand as sort of a second derivative to these AI theme. So whilst value was very strong in the middle of the upper end of the index, the top names, generally speaking, tended to be within AI. Although interestingly, you did see a lot of the auto manufacturers struggle this year, despite the weak yen environment, as they face increased competition from China and also tariff uncertainty. But as you said, there was, as I said, dispersion around style, sector, but also around some of the active fund managers that we look at, with a lot of the value managers generally performing very well, whilst the growth managers struggled. And just finally, one of the key themes that we have seen in recent years and also into this year is improvements within governance. As we've seen, a lot of businesses continue to improve on the governance front, either that's through reduced cross-share holdings, increased M&A activity, and improving the balance sheet by reducing cash, which should be helpful to the businesses and also shareholders more broadly.
Brilliant, Simon. Thank you. And then finally, looking at the year ahead in Japan, clearly a lot will depend on the election that we've got coming up. I think it's the 8th of February, so not too long to wait. And if the bond vigilantes really rein in the Prime Minister's plans. So what are your thoughts for the year ahead?
Yeah, I think with the election, obviously, it is an element of geopolitical risk. And I think that being said, of all the potential outcomes that I guess could occur, broadly speaking, we could still expect the LDP to come to do very well out of the result, and that will generally result in more fiscal spending. But it will depend on how the balance is between fiscal spending and tax cuts. And if they manage that quite well, then we should be a broadly positive environment. But as we mentioned earlier, if they don't manage that well, we could be in a situation where you're increase fiscal spending, but not providing the funding for that. Aside of that, however, the environment for Japan is quite strong going into next year. We should see continued economic growth supported by pro-growth, pro-markets prime minister with a strong focus on fiscal stimulus. I think inflation will continue to be elevated, and I think as such, the Bank of Japan will continue to try and call a cautious path, but continue to raise rates, but just being mindful of the effect that might have. And then we probably may see a appreciation of the yen going forward as a result of that. Another key themes that we should continue to see will be the likes of continued improved governance that should start to bear fruit. The domestic story looking very strong, and a number of the domestically focused businesses, especially those in construction, will continue to do quite well. In terms of, I guess, where we see different styles going forward, it's quite hard to tell at this point in time whether it will be a value or growth year, but we should see more dispersion, and it will still be very much a stock pickers market going forward. In terms of the bond market, as I said, that will depend on the political environment and how that goes going forward. But typically, it wouldn't have a significant effect on the equity market from that standpoint. Overall, it's a very positive market for Japan going into this year, with some strong underlying growth fundamentals, improving confidence, and a path towards interest rate normalization, which create a very fertile environment.
Perfect, Simon. Thank you. I guess one to keep an eye on. So thank you, and thank you to Richard and to all of you for listening. Did you enjoy the discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button, and we'll be back next week. In the meantime, you can head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date on our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. And finally, we do like to hear from our listeners. So if you've got a question that you'd like to ask one of our experts for the next podcast, simply ask them via the weekly comments page on our website. But that's it for today. So thank you to both Richard and Simon for your time, and to all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.